Well, the initial impact is going to be negative, obviously, given the fact that it'll have a monetary effect. But emerging market assets which have sold off, you look at currencies, you look at spreads, they've widened. So at some stage, they become attractive again. And once that happens, we think flows will return to emerging markets. But yes, immediate short-term impact negative, but long-term impact positive, especially for economies which show a desire to restructure, we show a desire to get to a more sustainable growth path. But clearly not good for economies which do not exhibit such trends. Well, we've held a long equity position for quite some time now. We like equities over bonds. Bonds, as in we are underweight investment grade fixed income bonds because we expect the yields to go up further. Um, and that position has not changed. You know, we see enough signs that global growth is picking up. You look at global PMIs, the diffusion index has picked up quite smartly. About 85-90% of the countries we track are showing PMIs above 50. So there are signs of global growth broadening out, which will be supportive to risk assets, especially equities. A jump in yields in the US is effectively a reflection of higher growth potential in the future as well. So that should support equities as well. Within equities, we tend to like more developed as compared to emerging, given the fact that earnings potential, the monetary policy environment is more supportive there. At some stage, when emerging market equities swell off enough, you would look to dip into them because valuations are fairly cheap as compared to historical past. Yeah, as I said, we like developed market equities. We are overweight US. We were underweight Europe earlier, but we've neutralized that a little bit, maybe a little overweight in Europe as well. And we are selectively positive on certain Asian markets. Within the fixed income space, we like shorter duration, high yield because we see economic growth remaining decent. We don't like the longer duration government or investment grade bonds where we recommend an underweight position. Yeah, if you look at the market reaction to what came out, it's been like kind of slightly negative because the market was looking for a lot of details which are clearly not there in the plan which came out yesterday night and today morning. We are fairly okay with what came out in the sense that it reinforces the commitment to market reform. And that is shown by creating this new reform agency, which I think is going to be headed by either Mr. Xi Jinping or Mr. Li Keqiang, which shows the seriousness to which the policymakers are addressing economic reforms. And that, I think, is a positive. What I think was a little disappointing was the absence of mention on SOE reform. But my sense is that if you allow the market factors to dominate and create a level playing field for the private sector, it automatically conveys the message that the role of SOE will come down in the future. And if you look at the data in China over the past 4 or 5 years, then the private sector is the biggest incremental generator of employment, contributing to about 2/3 of, or even higher, of new employment generation in the urban areas. They are equally big spenders on fixed asset investment, as also their contribution to profitability in China has gone up quite significantly. So the role of private sector and the market-oriented nature of reforms in China is positive. You know, there are some negatives. We are awaiting the details, which will come out over the course of the next few weeks. Markets will, I think, take a sense from what comes out in those details. But by and large, we think it's a decent set of package for the markets.